Well, friends, welcome. We are discussing about various assertions which are embedded in the financial statement. I think you have got already you have got a fair idea about what are these assertions. We'll continue our discussion on that. I am sharing the screen with you. In the previous session, we had understood that assertions refers to various representations made by management explicitly or implicitly, and these are the representations which are embedded in the financial statements, and the auditor uses these assertions to ensure or to check whether there is any potential misstatements in the financial statement or not. In representing the financial statement, uh, or while presenting the financial statement, management first of all ensures that they are presented in the appropriate financial reporting framework. And while doing so, these assertions are implicitly or otherwise made by management. The assertions basically deals with recognition, measurement, presentation, and disclosure of various elements of the financial statement. So each element of the financial statement, how when it is presented, when it is disclosed, when it is recognized, and when it is measured, certain assertions are implicitly or otherwise made by the management. And from auditing point of view, and we have seen these assertions are classified under three groups. Certain assertions relate to the transactions, or these are the assertions which are, you can say, mostly associated with profit and loss statements. And certain assertions relate to accounts balances on a particular date. So naturally, these are the assertions which relates to balance sheets. And there are certain assertions which relates to presentations and disclosure part of the financial statement, right? So for example, the assertions relating to events are occurrence, completeness, accuracy, cutoff, and classification. And assertions about account balances include the existence, rights and obligation, completeness, valuations, and allocation. Presentation and disclosure related assertions include occurrence, right, and obligation, completeness, classification and understandability, accuracy, and valuation. Up to this, we had discussed in our earlier class. Okay, and you see, this concept is little technical, so you have to minutely uh, try or minutely learn this thing, minutely read this content so that you'll be able to understand. First, we'll be discussing these issues in detail now. First, we are talking about assumptions relating to account balances at the end of the period. So, these are the four assumptions which relates to account balances. One is existence, second one is rights and obligation, third one is completeness, fourth one is valuation and allocation. Coming to existence, so this assertion says that assets, liabilities, and equity interest exist. So actually, these are the assets which are existing on the date of that financial statement, or liabilities are existing, and the equity interests are also existing. And the assertion relating to rights and obligation, it indicates that the assets are in fact rights of the organization, and the liabilities are obligations of the organization. And the assertions about completeness indicates that all assets and liabilities and equity interest that should have been recorded have actually been recorded. That means there is no unrecorded asset, unrecorded liabilities, or unrecorded equity interest. Coming to fourth assertion, that is valuation and allocation. It says the assets, liabilities, and equity interests that are included in the financial statement are at appropriate amounts. That means valuation is correct, and any resulting valuation or allocation adjustments are appropriately recorded. If some adjustments are required or some value needs to be allocated, that also has been done properly, right? So when management prepares the financial statement, management implicitly or otherwise makes these assertions, meaning these are the assertions which are embedded in the balance sheet. Did you understand this concept?
Yes, sir.
Okay. So it is little technical. I do agree it is a technical, but it is important for us to understand. Fine. Now coming to next set of assertions, which deals with transactions or events. So first assertion is occurrence. So when I'm saying this is assertion, just like first of all, let us say I am talking about the balances. Balances I had given you example. Suppose company shows this is bank balance. That means bank balance exists. They have the rights. If there is a liability, there is obligation like this. Similarly, coming to transaction, suppose company says this is salary payment. It's a transaction. So here management asserts or management makes an assertion that actually this transaction has occurred. That means people have worked in our organization and they're paid salary. Right. And they're complete. There is no unrecorded salary. That means as per records of the company, that means the transaction which should have been recorded, that has already been recorded. Okay, there is no such situation where salary has been paid but not recorded. That situation is not there. So therefore, it says transactions have actually occurred and transactions are complete and the amounts are also correct, accurately they are recorded. And the amount pertains to the period for which this financial statement is prepared. Let us say profit and loss statement is prepared for 1 year and this salary payment is for that year, not previous years, not for future years. And they are also recorded under proper head, that is actually salary payment. Okay, it's not a consultancy fee which is classified as salary. It's not like that. So management makes these assertions as regards to transactions or events, occurrence, completeness, accuracy, cutoff, and classification. Did you understand?
Yes, sir.
Okay. Now, third group of assertions, they are the assertions about what? Third group is about what? Assertions about? Who can tell me?
Sir, it's about disclosures.
Yeah, it is about disclosures, or you can say presentations and disclosure. First assertion is occurrence, rights, and obligation. That means events have actually occurred, assets are rights, and obligations are liabilities. Liabilities are obligations. Okay, in financial statement, assets, liabilities, occurrence requires various kinds of disclosures. So this assertion made that disclosures have been properly made. Okay, events are disclosed, which what is to be required to be disclosed, that is already disclosed. Completeness shows that all disclosure that should have been made is already made. Okay, and classification and understandability means financial statements are appropriately presented the way it should have been classified, appropriately classified, and it is understandable. It is there is a clarity in expression, and arithmetically also they are accurate. Financial and other informations are disclosed fairly, and amounts are appropriate. Okay, these are the disclosures. Events are actually occurred. Rights, assets are really assets are those assets are assets belongs to the company, or obligations are company's obligation. So like this, these are the assertions made about presentations and disclosures of the financial statement. Did you understand this?
Yes, sir.
Okay. Well, friends, now that assertions part was little technical. Now we are coming to next area. This is about types of audit. Various types of audit. We can classify them or can group them like this. Audit required under law, or second category is a voluntary audit. If audit is required under the law, you can say this is a legal requirement. We can refer to is at statutory audit. Is it not? So broadly, we'll divide audit into two categories. Financial audit we are talking about. So when under audit required under law, so these are some examples where audit is required under law. Can you read it? First one.
The company is governed by the Companies Act 2013.
Right. Then
Banking companies governed by the Banking Regulation Act 1949. Then electricity supply companies governed by the Electricity Supply Act 1948.
Right.
Then the cooperative societies registered under the Cooperative Societies Act 1912. Then the
Hmm.
public and charitable trusts registered under various religious and endowment acts. Then corporations set up under an act of parliament or state legislature, such as the Life Insurance Corporation of India. Then specified entities under various sections of the Income Tax Act 1960.
1961.
Yes, sir.
Okay. Yeah. See, in this situation, audit is mandatory. That means law requires that audit has to be done. All companies, all banking companies, electricity supply companies, cooperative societies, public and charitable trust, corporations, and specified entities to whom tax audit provisions are applicable. So they are mandatorily required to get their accounts audit. So we'll say these are the audits which are required under law, and you can broadly refer to it as a statutory audit. Now coming to other kind of audit which is not statutorily required, but still people do it. Some proprietary firms, some HUFs, right? Some partnership entities, they go for this kind of voluntary audit. There is no legal requirement for this kind of audit, but it is their internal decision or their internally they feel that audit is required and they conduct a kind of audit. Okay. Sometimes they may be requiring this kind of voluntary audit to avail some benefits, maybe for sanction of loan, maybe getting some subsidy from government, or sometimes this organization, maybe government, bank, etc., also gives directions that get your accounts audited. So accordingly, they get their accounts audited. So this is the prime difference between the voluntary audit and audit required under law. Hope you got a broad idea about this. Now question comes then, why people are, when statutorily it is not required, is there any necessity? Why people feel that they should get their accounts audited? Definitely there is some advantages of audit. That's why so many people, even if voluntarily there is no requirement to get the accounts audited, they go for audit of their financial statement. Right? Now, therefore, it is important for us to understand what are the advantages of audit. Now, are you clear on this concept? What is statutory audit and what is voluntary audit? This concept is clear. Then we'll learn what are various advantages of audit.
Yes, sir.
Yeah, it's clear now. Fine. Now, let's come to various advantages of why so many people do the audit even when it is not required. Okay, first of all, the chief utility of the audit is that the financial statement becomes reliable. Is it not? So another person, auditor is an expert. So when an expert gives an opinion that the financial statement gives a true and fair view, or audit, the expert gives some opinion about the financial statement, it is relied upon. And apart from that, apart from these chief advantages, the other advantages include these points. First of all, when accounts are audited, the financial interests of the people who are not directly associated with the company or who are not involved in day-to-day affairs, who are not uh, regularly dealing with the management, their interests are safeguarded, their interests are protected. Okay, there might be many people who might have invested money in the company. They want a kind of assurance that their money is safe and their financial interests are not adversely affected. So their financial interests are protected when accounts are audited. Is it done?
Yes, sir.
So audit safeguards the financial interest. Second, advantage, or one more advantage you can say, it acts as a moral check on employees who are committing defalcations or embezzlement. So, in many organizations, when the employee knows that auditor will come one day, he'll check all these transactions. So there is a fear that even if you commit some fraud, even if you commit some defalcations or embezzlement of cash or some other asset, the audit there is a possibility that auditor may find it out. Is it not? Possibility that auditor may detect the thing.
Yeah.
So therefore, so there is a moral check that auditor may come, so they will not be willing to commit these kind of things. They will not be willing to commit any kind of fraud. So it's a moral check. If they'll know no one is there to check, there will not be any audit. Then this moral check is not there. So this is one more advantage of the audit. Then audited accounts are also helpful in settling tax liabilities, settling loans, and determining purchase consideration for business. When one business is acquired, you might be knowing in accounts, you must have learned what is this PC, purchase consideration, how it is found out. To arrive at this purchase consideration, the audited accounts are taken as reliable documents. And on that basis, on the basis of audited financial statements, purchase considerations are computed. Audited accounts are also helpful for settling tax liabilities or negotiating for loan. That is one more advantage. They're also useful for settling trade disputes. So if there is a dispute between trade unions and the management, when trade unions demand, claim higher wages, higher bonuses, or claim some kind of compensation for the damage suffered. So audited accounts are helpful to arrive at the true amount of, let us say, compensation, true amount of wages. It helps. Audit can also help in detection of wastages and losses. Through audited financial statement, it becomes easier to identify in which areas expenses are more, which areas losses are more. Once that areas are identified, it becomes easier to control those losses, control those weaknesses. And the process of auditing also assures that necessary books of accounts and allied records are properly kept. So because auditor reviews all these financial statements, not only financial statements, supporting records are also reviewed. Is it not? You already know in the process of auditing. Auditor checks the supporting records also. So auditing ensures that reporting that the necessary books of account or allied records are kept. Audit also works as an appraisal function. Audit reviews the existence and operation of various controls. If some error is found, if some fraud is found in the course of audit, so naturally that identifies some of the weaknesses of internal control system. So auditing helps to find out that weakness. So it works as this is one of the appraisal function of auditing. Audited accounts are also of great help in settlement of accounts in case of admission of the partner or retirement of the partner. When a partner gets admitted or partners retired, for settling his share, for computation of goodwill, etc., audited accounts are more helpful. Government may also require audited and certificate accounts for issue of certain licenses or permits. Right. So these are some briefly, these are some advantages of independent audit. Therefore, even when auditing is not mandatory under law, many people go for audit. To summarize all these transactions, I'm showing you a list. First advantage is that it safeguards the financial interest. Whose financial interest? Who can tell me?
Sir, of the shareholder.
Of the shareholder who may not be actively interested, but their financial interests are protected. It acts as a moral check on employees. Settling liabilities for taxes, loans, purchase consideration, etc. Audited accounts are helpful. Settling trade disputes also, audited accounts are helpful. For detection of wastages, losses, audited accounts are useful. Necessary books are kept, that is assured by auditors, audited, that is assured by audit. Existence and operation of various internal controls, whether there is any weakness in the internal control, that also can be found. And for settlement of accounts at the time of admission, death of partners, also audited accounts are helpful. Government may also require auditing. So this is the list of 9 items we have discussed. These are called as advantages of audit, but there might be many more advantages also you can add to this. Okay. Fine.
Yes, sir.
Now, friends, one more concept we are going to learn now. When we are discussing about the scope of audit, at that time I had told you that scope of audit is, you can say, affected by certain inherent limitations. Now we are going to learn what are these inherent limitations. At that time we were discussing that there will be some inherent limitations of audit itself, and there are some inherent limitations associated with the internal control system. Do you understand what is internal control system? Of course, in later stage we will be learning this. But right now, do you have any idea about what when I say internal control system? What do you understand by that? Can anyone tell me? What is internal audit? Internal control system. Many times we are discussing on that. You can tell anything what is coming to your mind.
These are the rules, policies, procedures that an organization implements
Yeah, you're right.
or
These are certain rules or
discipline
procedures that the organization might be implementing to ensure that there is proper checks and balances in various events. Is it not? Suppose organization requires that to make a cash payment, at least 2 people should sign a voucher. That's a kind of internal control system. Without 2 person signature, cash payment cannot be made. Or if you want to purchase anything above 1 lakh rupees, you need a purchase committee's approval. That is the internal control system. Or you cannot do anything beyond the budget. Only when budget provisions are there, you can do that thing according to budget. That's also a kind of internal control. So in every organization, there are internal control systems like this. Did you understand? We'll be learning in detail about this in our subsequent class. But at this stage, are you able to understand what is internal control?
Yes, sir.
Right. First, we'll see inherent limitations of audit. As we are discussing, even if auditor applies audit techniques on 100% of the items, but still, it cannot give an absolute assurance that the financial statements are free from all material misstatement, whether they have caused due to error or due to fraud. Meaning, nobody can give assurance that financial statement can be free from material mistake. Why? Because there are some limitations which cannot be avoided. We call these limitations as inherent limitations of audit. And these are the some inherent limitations we have discussed. And individually, we are going to discuss all these things one by one. First of all, the nature of financial reporting. I'll be telling you what is that. Then the nature of audit procedures we'll be discussing. Third issue is about the timeliness of financial reporting and the balance between benefit and cost. Every organization wants that there should be a balance between benefit and cost. Accuracy always will involve some cost. If you want something has to be very accurate, you have to spend much more money. So somewhere we have to draw a balance between accuracy and cost. And there are also many other matters which affect the limitations of the audit. So now our discussion will be in these 4 areas within the framework of limitations of audit. First of all, nature of financial reporting will be discussed. Okay, let's start now. Now, coming to nature of financial statement, you know how financial statements are prepared. As students of commerce, you already know how, let us say, profit and loss statements are prepared, how balance sheets are prepared. You know, broadly, you know the process. Yes or no?
Yes, sir.
Yeah. And you also must be knowing that there are many areas in the financial statement where judgment is involved. That means management has to judge certain things. Let us say management has to uh, judge whether this money is receivable or not, whether it will be classified as normal debtor or bad debt. Okay. Or whether this particular transaction needs to be recognized as sales or not. It's a judgment area. And there will be some items in the financial statement, you can say, which will involve some kind of estimates. Let us say how to charge depreciation. You need to estimate the life of the asset. How much provision has to be made for bad debt? Is it 10%, 20%? It's also an estimation, is it not? So in the preparation of the financial statement, you face and you have to deal with certain areas where judgment is involved, some estimations are involved. And financial statement also involves many subjective decisions, assessments, or there are many situations which involve some degree of uncertainty, or there are some areas where there is a range of acceptable interpretations or range of judgments are possible. And because of this thing, you cannot give a guarantee that financial statement is 100% right. Suppose you have estimated bad debt provision is 25%. Can you give a guarantee that it will be exactly 25%? Not possible, because this is an area which involves estimation as well as judgment. And you charge depreciation at certain amount. Can you give guarantee that with that depreciation financial statement gives it correctly? May not be. Okay, that is also an area of judgment and estimation. Are you getting? And because of such nature of financial reporting, there is always a possibility that there might be some misstatements in the financial statement. Okay. Is it okay for you?
Yes, sir.
Now, coming to the next issue affecting inherent limitations of the audit. This is about the nature of audit procedures. So auditor applies certain audit procedures. We'll be learning all these audit procedures subsequently. Okay, risk assessment procedures and other audit procedures we'll be learning. But at this time, you need to understand that these audit procedures are to be applied on the information provided by the management. Now you see, the nature of audit procedure is such that it will work on the information which is provided by management. Is it not? If management doesn't provide an information and management hides some information, then on which audit you are going to apply audit procedure? Let us say management has received a notice to pay a penalty, and management does not show that notice to the auditor, and there is no other evidence also that notice has already reached the company, and consequently management has not provided any liability for that notice. So financial statement may not show true and fair. But unless that notice comes to auditor, notice is shown to the auditor, he cannot apply audit procedure on that. So the nature of audit procedure is such that if information is incomplete and information is not provided, auditor may not be able to detect error and fraud. Okay. And one more thing also, the intention of or the motive of audit procedure, motive of application of audit procedure is to collect audit evidences. And if there is intentional misstatements in a kind of, let us say, fraud kind of situation, or people join hands to commit a misstatement, or joint, or they people are in collude with each other. Two people decide. Let us say somebody is supposed to give the purchase order, another person has to supposed to approve it, third person has to release the payment. Let us say the three people are joined together. So somebody will give the purchase order, or other person will approve it, third person will make the payment. The transaction has happened. Okay. Even if in reality there is no such event, even if in reality no such event is taking place, but in the books of account, they may book a transaction because all the three people are involved. So in this kind of situation, by applying audit procedures, it is very difficult to find out whether the financial statements are free from material misstatements or not. Auditor doesn't have any specific legal power to investigate into situation. So auditor applies normally a normal audit procedure, keeping in mind that management has made every effort to present the financial statement in a true and fair view. And in case something is wrong, then audit procedures will normally detect such errors and faults. But normal audit procedures cannot detect a planned misstatement or a fraud. Right. So thus the nature of audit procedure also affects the inherent limitation of the audit. Third point, timeliness of financial reporting and the balance between benefit and cost. So accuracy is difficult, but the fact that it is difficult, the fact that it involves time, it involves cost, is not a basis for the auditor to omit audit procedures. On this ground, auditor cannot omit audit procedure. Auditor cannot say the implementation of the procedure is difficult, so I will ignore this procedure. No. Or time is too short, I will ignore this procedure. Or this time or this audit procedure involves cost. On that basis, auditor is not supposed to ignore it, application of a audit procedure. So what is expected? The auditor should plan his audit in such a way. The program should be made in detail and in such a way that within the available resources, he should be able to form an opinion whether the financial statements are showing true and fair view or not. That's possible only when audit is appropriately planned and programmed. Right. But the fact is that the timeliness, cost, and difficulty in application of procedures also affects the limitation of the audit. And they also contribute towards inherent limitations in the audit. There are many other limitations which also affect, many other matters which also affect the limitations of the audit. They include fraud. If fraud is committed, especially when fraud is committed by senior management or fraud is committed by collusion. Internal checks and controls are there to ensure that organizations' transactions flow smoothly. But if the people form a collusion, or there might be some senior management who are involved in the fraud, then it is difficult to find out such fraud by applying normal audit procedures. And when there is existence and completeness of related party relationship and transactions, if there is related party transactions, then it is again difficult to find out whether the financial statement is showing true and fair view. Suppose there is a related party. So normal price of a particular asset might be 20,000, but I may purchase from him 40,000 at 40,000. My intention is that I will be transferring some of my profit to that farm. Related party transaction, no issue. He will raise a bill, I will make payment. Okay, two parties, they are related. So any amount of bill is raised, other party makes a payment. But transaction may not be genuine. So therefore, when there is related party transaction, then also it is difficult to detect fraud involved in that transaction. And if there is some non-compliance with the laws and regulations, unless it is disclosed, auditor may not be aware of all laws and regulations which are applicable to the entity. Of course, auditor is expected to be aware of laws and regulations which affect at least the financial items of the entity. But there might be many laws and regulations, and it is also practically not possible for an auditor to understand the implication of all these laws and regulations. So if there is a non-compliance, it is again difficult for the auditor to find out, to form an opinion on the financial statement. That is one more inherent limitation than the audit. Future events, conditions that may cause an entity to cease to continue as a going concern. There might be some events which may cause an entity to cease. That means because of that, entity may be discontinued. Entity may not be continuing as a going concern. Certain events. So these events also contribute towards the limitation of the audit. Auditor cannot say at a particular point of time. Auditor always assumes, or let us say, the management also assumes that company will continue as a going concern. But certain future events may affect the going concern assumption of an entity. An auditor may not be able to detect that. That is one more limitations, one more inherent limitations of audit. These are some of the inherent limitations of audit we have discussed. Okay. Now, are you seeing the chart now?
Yes, sir.
Yeah. This chart talks about that there are certain limitations which affect the scope of audit. First of all, we have discussed the nature of audit is of test nature. There are inherent limitations of audit as well as there are inherent limitations of internal control. These things we have not discussed what is inherent limitations of the internal control. We are going to discuss that. And the inherent limitations of the audit involves judgment areas. And many situations auditor draws conclusions which are reasonable. Auditor can draw only reasonable conclusions. That means absolute conclusions cannot be drawn. And the audit evidences that auditor collects, most of the cases, that persuasive in nature, not conclusive in nature. Okay, that pursue to believe that this thing has happened. But that's not the conclusive. Suppose sales has been made, you got a sale bill, that is persuasive evidence that actually sale has happened. But that's not a conclusive evidence. That might be only a book entry, only a bill, sale bill might have been generated. So these are some inherent limitations of the audit. And coming to inherent limitations of internal control. In many situations, internal control may fail to operate. It becomes ineffective when there is collusion and people join. Collusion means several people join together to do a transaction in a particular way. Or if there are some positions which are overriding the controls, suppose very senior people, they may override the controls. Control is there, but they give direction to do a transaction, to record a transaction in a particular way. Then it is again becomes difficult for the auditor to ensure that the financial statement shows true and fair view or not. Right. So in these situations, when the internal control fails to operate, when there is collusion, when there are positions overriding the controls, all these things contribute to the limitations of the internal control, and which indirectly contributes to the limitations of auditor also. Because auditor relies on the internal control system. Okay. Is it clear up to this?
Yes, sir.
Okay. Now, little more things we will be discussing about inherent limitations of the audit. Oh yeah, I already told you this thing. Auditor involves auditing. The auditing process involves judgment areas. Okay. Well, friends, the file got closed. Let me share it with you once again. Yeah, I think you are seeing the PPT now. The
Yes,
PPT is
sir.
visible to you.
Yes, sir.
Yeah.
Sir.
So we were discussing about inherent limitations of the audit. I think you have understood that broadly that in auditing profession, what kind of limitations we face. Auditor has to make sincere effort uh, to express an opinion whether financial statements are showing true and fair view or not. But the problem here is that there is a list of inherent limitations in auditing, and there are also inherent limitations in the internal control system, which affect ultimately the opinion of the auditor. Is it not? Auditor has to exercise judgment. That is again one more issue. Which audit techniques has to be applied? Management is also exercising judgment in many of the items of the financial statement. Auditor also will be exercising judgment. He has to also decide the extent of audit procedure, to what extent he has to apply audit procedure, whether he has to apply it on 100% of the transaction or 20% of the transaction. That is also a judgment area. And auditor also has to assess the reasonableness of the judgments and estimates made by the management. Management makes some judgments, management makes some estimates. Auditor needs to estimate whether that is reasonable or not. And we know the evidences that auditor is collecting, most of them are not conclusive. They're only persuasive evidences. Suppose you want to verify the bank balance. You may ask for a, let us say, bank confirmation certificate. Is it not? With that, normally you will believe that that is an evidence that the balance is correct. Is it yes or no?
Yes, sir.
Okay. But who knows that, let us say, bank confirmation certificate might be a fake certificate. So what is conclusive evidence? You may go, okay, I will go to the bank and see the bank's monitor. Bank's computer system, that is conclusive evidence. But is it possible for you to go there? Bank will refuse. Bank will say, no, you are not authorized to see that thing. I will not show you. So now question here is that you collected an evidence, but evidence is not a conclusive evidence. Evidence is still a persuasive evidence. And the most of the cases that evidence that auditor collects are persuasive in nature rather than conclusive. Because of this thing, there is a rare possibility that absolute certainty can be attended in audit. Is it? And because of this thing, there is a possibility that there will be material misstatement, or there might be some error, and even there might be some fraud which may remain undetected. Okay. And the audit process is dependent upon the internal control system. And we have already discussed there are few weaknesses of internal control systems are also there. Few limitations are there. If internal control fails to operate, then that will affect the audit also. Internal control may become ineffective when there is fraud, there is collusion among employees, or if there are some positions who can override the control. So very senior persons, they are giving direction to do or to record a transaction in a particular way. So naturally, in that case, internal control system will fail because they are the people who are in a position to override the controls. So these inherent limitations will contribute. That means the limitations of internal control will contribute to the inherent limitations of audit. Okay, so we have discussed what are the inherent limitations of audit itself, and inherent limitations of internal control. They will also contribute to the inherent limitations of the audit. Okay, did you understand all these items which are listed in this chart? Tell me example. Tell me any area which you have not able to understand?
Sir, understood.
Do you understand?
Yes,
Okay.
sir.
Now give me, if you have understood, then try to give me some example. Let us say we are discussing about inherent limitations of audit. Okay, let us say judgment. How judgment is an inherent limitation of audit? As I told you, auditor has to apply his judgment whether this estimation is correct or not. It is judgment area, so it is a subjective thing. You cannot say absolute certainty can be attended. Reasonable conclusions. I give you an example that if you want to verify bank balance with reference to bank statement, you can only draw reasonable conclusion. You cannot draw absolute conclusion. Okay, and that evidence is also persuasive in nature. That is not a conclusive evidence. Okay, and coming to inherent limitations of internal control may fail to operate. In certain specific situation, internal control may fail to operate. Okay, let us say it may fail to operate. The example I gave you, suppose somebody changes the system state and backdating some entries. Internal control is there, but in this particular situation, it has failed to operate because systems date alteration is not controlled. And if there is collusion, internal control system will fail to operate. When there is management involvement, internal control system will fail to operate. Or there are positions, that is senior positions which can override the control. Internal control will fail to operate. And since auditor relies on the internal control system, auditor believes, okay, this voucher is approved by 3 people, it is okay. He accepts this. For him, that is a persuasive evidence. But who knows that all the 3 people have joined? They have joined hands. Then internal control has failed to operate. That affected the limitation of the body. Did you understand? Are you getting me?
Yes, sir.
Yeah. Okay. Now, friends, next concept is about relationship of auditing with other discipline. We'll stop here. We'll stop here. Next class, we'll catch up that thing, relationship of auditing with other discipline. Then how auditing standards are developed, that process also we'll be discussing in our next session. Okay. So thank you very much.